So my name's Jason Baggaley. I'm the fund manager of the Aberdeen Property Income Trust, otherwise known as API. API is a listed REIT that invests in a diversified portfolio of UK commercial real estate with the aim to provide an attractive level of income to shareholders. The fund is invested to provide a diversified exposure to UK real estate. Our biggest holding is in the industrial and logistics sector. We have 55% of the assets allocated to that sector, and it's one where we've been overweight for over 10 years now. It's a sector we really like and believe is going to have strong fundamentals into the future. We have roughly 18% of the fund invested in offices. Obviously, that's a sector which has got more challenges at the moment. However, we've seen strong letting activity in the stock we own, just demonstrating its appeal certainly to the occupier, if not necessarily to investors at the moment. 16% of the fund is allocated to retail. Our retail holdings are generally out-of-town retail warehousing, where we focus on budget retailers and affordability of accommodation so that our tenants can make great money from retailing from those units. The remainder of the portfolio is in what we classify as the other sector. For us, that includes a data centre and some leisure assets. Q3 was a good quarter for API at an asset level, with outperformance compared to the MSCI index. We saw capital decline though of 0.8% over the quarter, but that was half that of the monthly index. Shareholder return obviously has been more muted, with continued wide discounts, not only for API but across the sector. What I think is most encouraging is looking at the portfolio, its ability to continue to outperform the wider market, both in terms of capital values, but also on the income side. And we have great reversionary potential in the portfolio. Q3 was a busy time for us. Actually, one of the things which I'm most proud about was we received an updated Energy Performance Certificate, or EPC certificate, for one of our logistics units, where it came in with an A rating, as we'd expected, but actually quite a large negative aspect to it, in that the rating was A minus 53. That's one of the lowest we've ever seen across all of our portfolios, and demonstrated the very high quality of refurbishment to provide an operational carbon net negative unit. We did that by electrifying the heating systems in the building, but also by providing better worker welfare, biodiversity, photovoltaics on the roof. So really comprehensive refurbishment to provide a truly future fit unit. The other activity which I am very proud of over the quarter was our lettings. So I mentioned earlier that we've got 18% exposure to offices, and that's where most of our voids have been sitting. And we've seen great success over the last few months in letting that space, demonstrating that our focus on investing in assets that people want to work in, people want to occupy, has been working. So we've let space in offices in Bracknell, in Reading and in Birmingham, making quite considerable dent into our voids, so that the effective vacancy rate as at the end of September was only 4.4%. Well, UK real estate has certainly been out of favour, as have many real assets. And one of the main reasons for that has been the rising interest rate environment. So I think it's fair to say that one of the most likely triggers for a re-rating in the sector is going to be when people are comfortable that we've reached a peak of interest rates and they're beginning to fall, and the alternative returns available from money in the bank or gilts declines. Maybe we're beginning to see that already. Obviously last week was quite a good week. But I think that's going to be the key trigger. But the general economic environment will also have an impact. And that's where I think having a portfolio that can demonstrate rental growth through reversionary potential, as we have, can provide capital growth through having good quality assets that re-rated fairly considerably at the back of last year, but are now primed to enjoy capital value growth as we see interest rates and therefore yields come down, will be the triggers. And once people are confident that they can see stronger performance from the underlying portfolio, I'm sure we'll see investors coming back into the listed sector, where the very wide discounts obviously give much greater potential upside on returns in the near future. Thank you very much for listening to this. I hope you found it interesting. If you'd like any further information, please do look at our website, or there's more information within the listing to go with this. And please do contact either the Aberdeen sales team or myself directly. We're delighted to help you.